Hello and welcome to Africa Business Weekly, where we bring you some of the most impactful business stories across sub-Saharan Africa every week. I'm Kenneth Igbomo, and it has been a very busy week for business news on the continent. And we'll start the show from the south of the continent, where Tanya Abinama is standing by to give us a run-through of the key stories in South Africa this week.
Hi, my name is Tanya Habimana, and these were the big stories out of Southern Africa this week. We'll start with the latest investment trends into Africa's startup sector. We spoke to Sneha Shah, a board member at the African Leadership Foundation and ex-head of Thomson Reuters in Africa, who has been closely watching startup activity and success stories on the continent. Let's take a look.
Education in Africa is a really big problem, and we saw during COVID how deeply impacted communities were. And communities that had access to digital education, they did better academically, but mental health became a real problem, right, for remote education. And communities that didn't have access to digital, there was a physical health problem, but there's also a gap in how they were able to catch up to people that were getting digital education. And so there are solutions ranging from, the African Leadership Academy that teaches entrepreneurship to young kids from 15 to 22 and teaches them to actually be leaders for Africa and build businesses, to Spark Schools, which is taking the underserved communities, right, and taking them and giving them access to a high quality, affordable education that isn't always digital, but is giving them something that they really need that will then get them on the ladder. So all of those things are really important. And I think we need to, when we think about Africa, a lot of talk goes into the fourth industrial revolution and digital technologies, as it should, because we don't have legacy infrastructure to break. And so we go there faster, but we also have real communities that aren't going to get access to the internet, that aren't going to get access to digital for a long time. And so we need the types of, Spark Schools and those types of solutions, as well as we need the digital ones.
Let me ask a silly question. Is the money there?
Absolutely. The money, it's amazing. For me, just watching over the pandemic what happened to startup funding in Africa has been mind-blowing for me. So there's a newsletter I follow called The Big Deal, and they track funding coming into the continent. And so in 2019, there was $1.4 billion raised on the continent by startups. In 2020, it was 1.9 billion. In 2021, it was 4.1 billion.
Whoa.
It's the highest we've ever had, but also compared to other emerging markets, we're raising faster and we're raising on a more consistent basis. In Q2 this year, we had the highest year-on-year growth that we've ever had in terms of startup funding. We raised 125% more in terms of startup funding than we did the same time last year, whereas the rest of the world was actually declining. So the rest of the world, startup funding declined by 29% in this last year because of all the economic crisis, supply chain issues, etc. But we've actually gained. And so I think that's the really interesting thing. And then you're going to ask me, where's the money coming from?
Exactly. Right? I was preparing that question because I was going to ask you just how easy is it to raise this money? Do you have to pull teeth, or people are clamoring all over wanting to try and bring in the money?
I think there's still an aspect of pulling teeth. It's uneven. So what we're seeing is there's a lot of American investors. They're probably the largest number of investors on the continent. But if you take out investors that are only involved in one deal, then actually African investors, and this is again data from The Big Deal, African investors are actually the most prolific investors on the own continent. And that's what's exciting for me. That has never happened before, where our own continent is investing in ourselves at a rate that we've never seen before.
And then in more news, moving African markets, the United Nations University recently launched its latest natural disaster report for 2021-2022, which showed fresh records for disasters with $280 billion in damages and some 10,000 lives lost. We asked Dr. Jack O'Connor, lead author and senior expert at the United Nations University, about the way forward for mitigating continued risk.
I think this is one of the messages of the report. All these disasters, easy to feel overwhelmed and lose hope. But there is a lot of good being done out there, and there is an increase in concerted action. I mean, even if we just think about how much things like sustainability, climate action being talked about now compared to, say, 10, 20 years ago, you can see that it's much more in the global consciousness. And this plays out when we looked at the different disasters in our report. We looked to solutions that had been or could be applied in the different cases and looked to see how they were perhaps interconnected. And we found a lot of very innovative, creative, and promising solutions that have to do with, for example, letting nature work by using natural processes and restoring nature to help us have more tools to buffer against risk, to ways to consume more sustainably, using different types of materials or ways to reduce our consumption of materials as we've learned more about the impact of extracting materials and the environmental and social cascading effects of doing that. So yes, I think there's a lot of reason for hope, and we just need to promote these solutions more.
Yeah. Jack, I'm not asking you to criticize the United Nations, but I'm asking you to look at your report and the recommendations that you have and try to connect to the agenda that we are seeing that's being set for the COP27 meeting that's coming up at the end of the year in Egypt. Do you see interconnectedness?
Absolutely, I do. And at the last COP26, there was a strong message of interconnectedness going around between the delegations. There was a lot of talk about how the climate crisis is interconnected with the biodiversity crisis, and these need to be tackled together. In the upcoming COP27, I think the two big themes there will be adaptation and loss and damage. And for adaptation, the question is, how do we do this? How do we measure this? What actions can we take? And a lot of the solutions in the report deal with mitigation of hazards, but also ways that we should adapt. And in terms of loss and damage, we also like to point towards non-economic loss and damage. So what is the value of things like ecosystems that we are degrading, and what is the cost of losing them in the context of vulnerability to disaster?
Thanks, Tanya. And let's now move to East Africa and find out some of the stories that have shaped headlines this week.
Good to be on the show, Ken. In East Africa this week, the government of Ethiopia announced a discovery of about 7 trillion cubic feet of natural gas in the Ogaden. And the property analysis and consulting firm Netherlands Well and Associates verified the existence of the reserves and handed the first gas reserve certificate to the country's Minister of Mines and Petroleum. We spoke to the global chairman of Fairfax Africa Fund on the developments.
The 7 trillion cubic feet, from my understanding and watching the press conference the other day, it's actually the proven gas reserves, or at least the certification of what exists today. And just to go back very quickly to history, a lot of exploration work was done in Ethiopia going back to Emperor Haile Selassie's time, but nothing really significant materialized. So what I think the Ethiopian government has done recently, very smartly, is what exactly do we have? I mean, can we certify it? So they went and got this very prestigious American firm, which has a track record of certifying reserves. So the 7 TCF, the 7 trillion TCF, trillion cubic feet, is what is estimated to be on the ground. So when you say, is it newly discovered? No, it was already there. It's just that nobody ever really proved it, or at least certified it to a more precise, more reliable quantity.
And what economic viability does that really present to the Ethiopian economy? Because if we're talking about new discoveries, but then the difference is in certifying the country with the first, certificate of the presence of these reserves. What is the economic viability there?
Right. Very good question, actually. So to certify what's there is one step, but as was said by the minister and the consulting firm, the next step is to monetize it, at the very least to try to monetize it. So what does that mean? So if you are, and we've done a number of these kinds of deals in Africa and other places, if you, as a government, present to the investors this kind of reliable data, that it entices investors to proceed. I mean, I'll be honest with you, over the last 10, 15 years ago, we dealt with a lot of big companies that were potentially interested, but the numbers then were like in the 2 trillion cubic feet range, which wasn't that viable. Yeah, it was okay. Now you've upped it to 7. It really is very significant. So that's what it means. It monetizing the amount. Now investors know what they're getting into. I think is very, very significant. And at least it will now start attracting sizable, large, credible investors when they see these kinds of certified reserves. And then just to add to that, in monetary terms, I'm here in Europe this week. I was in Germany last week. I'm in Italy today, and I'll be going to other parts of Europe the rest of the week. Gas price and the availability of gas is a big topic, right? Gas prices, for example, over the last 10 years have gone up by 10 times in Europe. And Europe is now looking to source its gas needs from other places. So I think when you ask me, what does it mean for Ethiopia? Ethiopia could be down the road, could be one of the alternative suppliers of gas to Europe. Now, the Ethiopians have made it clear that some of it will be used as feedstock, for example, for the fertilizer plants that they're planning to build. But considering that the 7 trillion and then even more, there are indications that there's even significantly more, Ethiopia could actually be a gas supplier to Europe. So, and it'd be worth, in my view, tens of billions of dollars over the next decade or more. So it's actually a very significant step for Ethiopia in terms of monetizing what's on the ground, which it hasn't really done in the past 30, 40, 50 years. So this might be, I think, in my view, the first step towards that goal.
I mean, it's not the first time the government is trying to monetize the gas and oil reserves in Ethiopia, but I mean, when you look at the company, the Chinese company that was awarded a few years ago, the concession agreement to explore gas and oil in that region, it hasn't been able, that is according to the government, it hasn't been able to honor its financial obligations. It seems as though the government is already struggling even with that process of monetizing. What is going on?
So, listen, as you said, I mean, if you look at the last several decades, there's always talk. And I remember, I'm old enough to remember, even during the old days, there was always talk that significant gas and oil is available in Ethiopia, but nothing really material. So they have now taken a smart, radically different approach to saying, wait a second, we know there's something there. We get it certified from a very credible company. And then now, and this is what the minister was saying the other day, we're going to approach large, credible companies, not second tier or third tier or speculators, because you now have something tangible in hand, a very large quantity. And I was just researching it the other day. I asked one of my staff to look into it. At 7 trillion cubic feet, it's potentially amongst the 40 largest reserves in the world. It could even be ranked higher. And we saw some number, it could be around 27, 28. It's pretty substantial. So they can now go to the big guys, okay? At least the ones who have a track record, because they can say, here's the number. In the past, and you mentioned this company, this Chinese company, it certainly wasn't a major Chinese oil and gas company. That much we know. So maybe now you can get the Sinopecs, the Exxon Mobils, the Chevrons of this world, and Total to take a serious look at Ethiopia, because you've taken the real serious step of certifying what's there. Now you can at least grab their attention. And also, as I said, look at the global environment we're in right now. Very severe shortage, especially here in Europe, of gas. And they're definitely, so I think the timing is very important. And I just wanted to add that the Ethiopian government in the last three and a half years have rejigged or redone its natural resource policies. So if you look at the total exports of natural resources in 2019, it was less than $100 million. 2020, around a year and a half later, it was over 500 million. So they're on track because they've redone the policies, they've given more incentives. So this needs to be seen in a holistic way as part of the overall reform the government is doing to monetize and to better utilize its natural resources. I was with the CEO of one of the big companies that does oil and gas recently, and he was telling me Ethiopia is one of the last potentially large unexplored or underexplored countries in the world that he's aware of, and he's been in the oil and gas business for more than 30 years. So this is, I think, will give light to the fire kind of thing for others to start looking at Ethiopia's natural resource space. And then just the final point on this one. I know we're talking about gas here, but if you look at the overall opportunities in the mining sector, in the natural resource space. I mean, there's potash, tantalum, gold is now being explored. So it will give impetus to others also in the natural resource space to start looking at it when you see these kinds of big certifications of potentially large gas reserves.
Zahmiddin, I guess that's a beautiful story, but is there a concrete plan or a roadmap through which the government wants to reach out or to attract investors within this field of gas and oil? Because that is the basis. I mean, if the government is to go to the investors, there has to be a concrete strategy. Is there such a strategy that the government wants to follow to attract investors?
Right. As I said, they've redone and rethought their policies towards how to attract. And the press conference the other day the minister was very clear. They're going to do this ASAP. I mean, they have something in hand right now. So they'll start a two-tiered. One is very immediate, very quick. Here's what we have. But secondly, and he emphasized it 2-3 times actually. Now they'll be dealing with credible players, and we've had a lot of interest. I've been observing that sector for a number of years. Not many of the large ones ever showed up. And if you look at the last 10, 15 years, very, very few. In fact, none of them. I remember back maybe 10, 15 years ago, I think one big multinational kind of looked at it. But all the others, there didn't seem to be a coherent strategy in the past. But it now sounds like the way they're starting, the way they rejig their policies, and the focus that they've given to, as I said, certifying it, making it easy for investors. I mean, if you look at us, if somebody approaches me with a proven reserve like this, I'll be much more inclined to start looking at it instead of somebody just speculating, well, we have 2 trillion, 5 trillion, 6. So now fast tracking it is part of the strategy, a holistic approach to monetizing it in a smart way, but more importantly, engaging only might be the stronger, but primarily big players. And I think then there was I hope, and I think they can monetize this thing in a relative short period of time.
Also from the region, the Nairobi Securities Exchange is expecting the first main market segment listing in more than 3 years before the end of the year. And Bithe Mwema, the Chief Business Officer at the NSE, shared the expectations.
When it comes to looking at the market, we actually saw a drop when it came to equity trading as well as bond trading. What happened in the first half of the year is our turnover was actually down 22% compared to what was happening last year. And this is with regards to the turnover of equities on the NSE. Now, certainly our performance as the NSE, the company, was tracking this performance because our largest revenue earner is the levies that we are able to attract and charge when it comes to transactions on the equities market. 2 key things happened for us in the first half. First and foremost, there was the emergence of the war between Russia and Ukraine. Now recall that our market is largely foreign traded. So when this destabilization happened at a global scale, it had a direct impact on our volumes, and we saw a slowdown when it came to foreigners investing in this particular market. The second thing that we did see in that first half was also a pullback when it came to trading on bonds. Now, we are in an environment where the interest rates and yields have been on an upward trajectory. What this has meant is for existing portfolios, they have been underwater because they have been necessitated to mark to market. As a consequence, we've actually seen a reduction in trading volumes. And by the first half of this year, we were actually trailing last year by 18% with regards to a lower volume with an element of the turnover that we were trading at that period. Those were the key things that were happening with regards to the revenue for the NSE. But nonetheless, as the NSE, from a strategic perspective, we've actually been diversifying our revenue base. We do have other revenue sources that were able to actually reduce the impact of the loss of revenue from equities. And overall, our revenue standpoint was actually 2 percentage points below where it was at last year, giving us a cumulative turnover of 360 million shillings that were reported for that period.
I mean, Bithe, someone would have thought the fact that investors, especially global institutional investors, reallocated that capital to global fixed income markets, that would have translated into perhaps increased activity at the bond market at NSE. But that wasn't the case. Why?
I think if you look at either African markets or global markets, activity was hard hit. The global investor sentiment was actually slightly averse to risky assets, and we did see a move from people holding equities and looking for other safe havens, especially gold. This was actually tracked in our BALs. What we did see is that in as much as investors were pulling away from equity stocks at the point in time when the Russia-Ukraine war started, we actually saw more interest when it came to gold, and the NSE does have a gold asset commodity, which is the new gold ETF. This has been offered by Absa. This particular asset class actually saw a stellar performance from its inception. This year alone, we were able to generate almost 6 times worth of volumes traded compared to what it traded last year. So what was happening in Kenya, what was happening at the NSE was not uncommon with regards to what was happening in Africa and globally. And really it was just a risk aversion strategy where nobody was too sure of what was happening. And the second thing to consider for Kenya was the current election cycle that actually dampened activity. But nonetheless, what we did see was a pickup when it came from domestic capital looking at opportunities in the market. As at the first half of this year, at the end of June to be specific, the price to equity ratio for the NSE was 9.5 times. That actually saw a lot of domestic capital come and pick up the blue chips on our BALs. We've actually seen a recovery of that price to earnings ratio, and it's now trading at about 10.5 times as we speak today. What that tells us is, yes, there was the risk aversion. Yes, there was a pullback, especially from the foreign investors, but then there was an attraction from domestic capital that came in to participate in the market. And in essence, what that is also giving us an indication is in the month of July and August, we've actually seen a bit of a recovery on volumes. And once we're done with what is happening with regards to the Kenyan election cycle, we do expect a recovery, have seen a recovery over the last 2 election cycles, and we remain optimistic with regards to the volumes that we expect to see on the BALs. But maybe something that you might want us to focus on is what are the other product lines that have been able to generate income for us? Because in essence, the market was down 22%, but our revenues as an entity were only down 2%. That could be something that we can focus on and explore just to flush out what is the revenue profile, what is the product profile at the NSE that was able to sort of mitigate the losses and not have a one-for-one match with regards to what was happening on the BALs.
These are some of the unique stories from East Africa this week. Ken, back to you.
Thanks so much, Fiona. From West Africa, we've had a productive week with some economic data coming from Nigeria's National Bureau of Statistics on the second quarter GDP figures. The financial derivatives company says the sectors that expanded in the quarter have low impact on unemployment, which is around 33%. CEO Bismarck Rewane explains further.
I think the numbers have some strength. I do not doubt the integrity of the numbers. And also the numbers tell you a story. But firstly, let me correct a misconception, a popular misconception amongst economists, analysts, and investors. GDP is an output measure, not a revenue measure, right? So it's possible for you to actually have more money from producing less oil, but that is negative growth. The fact that you produce fewer barrels this quarter than last quarter, you can have negative growth, but because the price of oil has increased, you will have more money. Okay, so it's an output measure of goods and services. Secondly, we are measuring the rate of change between Q2 in 2022 with Q2 in 2021. And if you go back to Q2 in 2020, you find that was when the lockdown had its severest impact. So we started from a low base, we grew 5% in Q2 2021, and we've now grown by 3.54% in Q2 2022, compared to 3.11 growth in the first quarter. Okay, so in terms of a trend, it's moving in the right direction. In terms of total output, the nominal GDP actually dropped marginally, right? Because yes, the economy is in a recovery mode, but it hasn't recovered to where it was prior to the shock. Secondly, it was at the beginning of the Q2 that we had all the shocks, the diesel shock, the exchange rate depreciation, the aviation fuel shock, Russia-Ukraine, then the food crisis. So what has happened ever since, right? There's the lag between exogenous effect and impact on the economy. Also, what we call the outside lag, the time between when you have the shock and when the policymakers respond. Both of these cases, there's some long lag there. Now, what does it mean? It means that this economy is moving in the right direction. It's good news, right? But that it will take some time before you feel the positive effect. What you're going to feel in Q3 is a negative impact of the carryover of Q2 into Q3.
I'm happy you said that, because analysts that I've spoken to, economists that I've spoken to so far have said we have to wait till to see the Q3 numbers. Yes. Very important before we then know or see the full impact of the Russia-Ukraine war, especially.
Yes, because you see, it's one data point does not make a trend, and your economy is more vulnerable to exogenous shocks than endogenous shocks. So what are we going to see? There are some policies like the $265 million which was put into the foreign exchange market, which has helped to stem the hemorrhage of the exchange rate for now, right? So with that, and the fact that in Q3, we increased the price of petrol from, at least in Lagos, from 165 to 180. Every 10 naira increase in the pump price reduces the fiscal deficit by 250 billion naira. And so in Abuja and other places, it's gone up to 190, some places they're 200. So first of all, by dismantling the uniform petrol price across the country. 2, by allowing it to creep up there, we'll see that. We've also noticed that they've gone on the I&E window, gone down to 231. That helps to bring convergence variables into the equation. And so this morning, the exchange rate appreciated to 697 from 700 and what have you. And this other one has gone there. There's some intervention in the retail market. So we are going to be seeing that. But what I want the consumers and viewers to understand is that we now probably have a handle on some of the leaking of the crude oil. Tom Polo and others are,
Yes, some might argue that remains to be seen. It's a new contract. We've hemorrhaged.
No, it's a renewal of an old contract.
Yes. So we've hemorrhaged since the beginning of beyond that, but before that, but up until now, we have, just looking at the barrels, daily production fell to 1.43 million barrels from 1.49. So we know that is still a problem. But I want us to talk about, broadly speaking, now the sectors and some of the notes, comments you made in the report.
Yes, okay.
The sectors that have expanded are not the ones that are, labor intensive.
The ones that expanded, road transportation, obviously there's been a shift from rail and air to road transportation, but then that's where this insecurity problem is. There's coal mining, water supply, quarrying, ports and post and courier and broadcasting. None of this have any impact on employment and activity. But of the 46 activities that are monitored by the NBS, only 15 expanded, with about 33%. The previous quarter, about 50 expanded. So now the sectors that are humming, that are now reducing, so that's 1. 2, the contracting sectors, right? Rail transport, livestock, crude oil, and metal oil. These contracting sectors are very critical to the economy. But that's not even the problem. The problem is that when you now go to the slowing sectors, then you now see the full impact. Those slowing sectors are the ones that employ the most people, that have the highest employability. So in reality, some of these sectors are actually in a recession. The crude oil sector has been in recession. It's been negative growth for the past 6 or 7 quarters. So even though the economy may not be in recession, the drivers of the economy itself could be in recession. Yeah. So we need to lift those sectors out of their negative. But the good news is that the petroleum sector dropped from -20 to -12 or something like that. Therefore, it's reducing, the negative factors are reducing. Therefore, there's some glimmer of hope.
Is there a glimmer of hope for the manufacturing? You also noted in your report that the purchasing managers index, we've seen that oscillating in the last several months. But I'm trying to understand, are these manufacturers optimistic? We know a lot of them have
they're speculative. Many of them are front-loading their demand because they are afraid they will not get forex when they need it. So they don't want to be out of the market. Now that the forex situation seems to be moving gradually towards some semblance of certainty, right?
In terms of the rate, but not in terms
no,
of
the rate
supply.
and supply, right? Because once the pipelines are secured, you are going to get some dollars. There's no question about that.
But that's another if there, because we have to wait and see for that, obviously,
but
for that to take effect.
That will happen, and therefore, let's be cautiously optimistic. Let's not start bringing out the champagne glasses too soon. But definitely from what I see some, rather than gloom, I see some
A silver lining
somewhere very,
in the clouds. Agri sector, that was also a little disappointing. I know that this government has hinged many of its pillars and economic agenda, growth agenda on the agriculture sector, but the numbers are not.
You see, I mean, there's a lot of talking, there's a lot of words. The reality is that when you add all the intervention programs together, it comes to about 3-4 trillion. In a 180 trillion naira economy, that's nothing. It won't move the needle.
Also from the region, airlines struggling to repatriate trapped funds from Nigeria got a reprieve after the partial release of $265 million by the Central Bank of Nigeria to airlines for the settlement of outstanding ticket sales. Kamil Alawadi, the regional vice president for Africa and the Middle East at IATA, explored this story further.
We're pleased that Nigeria took this positive step forward. I think it's good for the aviation industry. I think Nigeria's government sat down and calculated the damage it would incur if it remained being the leading country in the world in blocking funds for airlines. I encourage the other African states who have also blocked some funds to the airlines to do the same. It's positive. It's good for the aviation industry, and it's definitely very positive for Nigeria.
Because when you look at this challenge we're seeing play out here, yes, we're dealing with an FX crisis in the country as it is right now. But I'd like you to speak to more or less that political will that it takes to address the challenges like these, and more or less the impact it could have on the bilateral agreements.
Let's reverse the story a little bit now. If Nigeria sold crude oil to the U.S. and the U.S. held its payments, it'll be devastating for Nigeria, and vice versa. Airlines operating in and out of Nigeria bring good business and it contributes to the GDP of the country. Holding funds from the airlines because of an FX issue, of course, damages the aviation industry. And it also damages the reputation of the country, and then subsequently hurts the GDP. If foreign investors will think twice about investing in a country that doesn't release funds to foreign organizations. When it comes to the bilateral agreements, it's very clearly stipulated that funds should not be held when transactions occur. So that's why I say it's a very positive move by Nigeria to remedy an issue that was taking too long to fix.
All right, but I'd like to know how IATA has been intervening in situations like this, both in Nigeria and other countries that are affected with these sort of challenges.
We don't come in heavy-handed. We try to assist. We first try to understand the situation, and then maybe assist the entities within each state to resolve these issues. We advocate, and our whole goal is to ensure that we have a sustainable, safe growth of the aviation industry. And that includes airports, handling agents, and all parts of the aviation industry, and of course the airlines themselves. When we see a hiccup that can cause damage to the aviation industry, we step in and try to work with all parties to resolve the issue. And initially it was quite difficult with Nigeria, but we're happy to say that Nigeria did take the positive steps forwards to fix the issue.
But when you look at how countries are recovering from the impact of COVID, especially the aviation sector, and I'd like you to speak to what we're seeing play out across the countries that you engage in, especially around the West, in West Africa and Africa, and more or less this sort of investment we've seen coming to the market in that time.
Yeah, so you know, I mean, it's not news anymore, but I mean, the aviation industry was almost destroyed by Corona, and of course, that negative impact made it difficult for the aviation industry to actually survive. They were taking their last breaths. As the situation started to improve, the aviation industry, or specifically the airlines, started to recover, but of course they had very, very thin margins now, and in many cases they were in huge debts coming out of Corona than they were when they came into Corona. So the government support within each state or between states for the aviation industry definitely does help the aviation industry recover. Okay. But of course, we have other things like the high prices of oil right now that also now hamper the aviation industry once again, making it a tough struggle to climb back out of debt.
Yeah, because when you look at that, yes, like you rightly talked, the geopolitical shocks are also more or less impacting prices of aviation fuel across board, and countries are dealing with it in different ways. But I'd like you to speak to the sort of impact we're seeing play out across board, especially in Africa here.
And in Africa, you mean the impact of fuel over Africa? It's of course detrimental, and so you know. There is a relationship between the price of oil, crude oil, and the price of aviation fuel. And of course, generally, just before, let's say in 2019, the difference between the price per barrel of aviation fuel and crude oil was about $25. Today, we've seen it hit up to almost $50, which means that airlines have to pay higher prices for oil. Not because the oil just went up, but because the refineries are charging more to produce the aviation fuel. And of course, that is a negative impact, not just on the aviation industry as a whole, but also on the GDPs of the countries that suffer.
Yeah, because now we're seeing these headwinds play out from geopolitical tensions. We're also seeing countries battling to deal with the inflation challenge as well. And quite a lot of headwinds playing out at the same time. But more or less, looking at the continent, and we're seeing the block funds playing out as well, like we rightly discussed with Nigeria and some other countries and how they're dealing with that. But then, how does this affect the progress of the single Africa air transport market?
It actually doesn't. So SATM is a separate issue that we plan to handle in 2023 fully. So it's a distraction to, let's say, the implementation of SATM, but it doesn't actually affect it directly. I think if presented correctly to all the states involved in the African continent, SATM would have been one of the ways to relieve the stresses on the government when it comes to supporting their national airlines. It just needs to be presented, and a plan needs to be developed and then subsequently implemented for SATM to go forwards. But the current situation today, I think, indicates the importance of having a fast track to implement SATM as early as possible.
Brings us to the end of Africa Business Weekly, and a big thanks to Tanya and Fiona for the regional updates. I'm Kenneth Igbomo, and we'll be back same time next week for more weekly business stories across sub-Saharan Africa. Thank you so much for watching.